Welcome back, everyone. I hope you enjoyed your lunch. And just flashing up the slide real quick to remind all of you that the views and opinions expressed by our speakers are expressed in their personal and professional capacities. They don't reflect the opinions of the organizers. That's SGX and Equities Tracker. So, folks, as the joke goes, for those of you in Singapore, do you know what our national bird is? It's the crane, because everywhere you go in Singapore, you can find cranes dotting the landscape. It feels like Singapore is constantly under construction. It's an island that's always changing. It never stands still. So it makes sense that as an investor, you want to have some idea of the construction sector in Singapore and whether it's worth putting your money to work in the construction business. To help you with that, we have Mr. Nicholas Yon. He's a research manager from Lim & Tan Securities. Over to you, Nicholas.
All right, thanks, Edward. Hope you can see the screen. All right, good afternoon, ladies and gentlemen. My name is Nicholas, and I'm from the research team in Lim & Tan Securities. Thank you so much for attending my talk. I understand that it is in the middle of the day, and you're probably just had lunch and feeling sleepy. But however, I hope that what I'm about to share with you today and show you guys, you'll be able to learn more about the construction sector in Singapore, and maybe hopefully identify some construction ideas that will hopefully boost your overall portfolio. All right, so this is a disclaimer. Okay, first and foremost, before we begin, I think it is important to go through the construction process. It's not necessary to understand, but it will help in understanding how construction works overall. So if we can identify the bottlenecks or constraints in this whole supply chain or this whole construction process, then we would know where to invest. So what are bottlenecks? Bottlenecks are a point of congestion in a production system or process. So for example, if a queue in a supermarket has a long queue because of only one open counter, then that would be the bottleneck. Or if there is a long queue in the supermarket or long queue waiting to just get into the supermarket because of COVID-19 safety distancing measures, then that is the bottleneck, right? So similarly, if we can identify the bottleneck, then we can identify where the resources should and will pour in. So hopefully this will alleviate the bottleneck, and this will help us generate better investment ideas because we already know where the money is flowing into. All right, so let's begin. So first of all, we have land. Land is the first thing always. So as to speak, the first thing should always be an idea of what you want to build, right? So this land can be self-owned or it can be bought from the government through GLS, which stands for Government Land Sales, or it can be bought from other people via an en bloc, right? So these are the ways you can get a land. And who are the ones looking to buy? It can be broadly categorized into three. So firstly, property developers building condos or property in nature. They're the one looking to acquire land for the land bank. Or two, corporates wanting to build a new factory for the operations, right? Or even the government wanting to start a new public infrastructure project, such as the MRT or a new highway or some factory, right? However, these companies usually have no expertise in actually building what they want to build. So they tend to tender it out via a contract to main contractors. So think of these main contractors like a project manager. Sometimes they have the expertise, sometimes they don't. And if they have, good for them. But if they don't, they usually will sub-tender it out to other companies with the relevant expertise. So under this block, we have many subcontractors, and all of them specialize in certain skill sets that will help to complete the intended project, right? So first off, we have the cement. So you need to have the raw materials such as cement, and under this, we have companies like Penn United, Engro, Hong Leong Asia, right? So some companies who are in construction might have other business segments. For example, like Hong Leong Asia, they are in construction, specifically cement, but they also have operations in China manufacturing truck engines, right? We also have steel, which is a foundation. For that, we have BRC Asia, Net Steel, HG Metal. We have excavators for you to actually start work on the actual site. We have KTC, Chuan Lim, Hua Tiong, and we have piling for you to pile the land and flatten it so that you can actually build things on it. And we have companies like CSC Holdings. We also have crane players. They're the ones that does the heavy lifting, literally, and they have to lift heavy objects up and down. And for that, we have companies like Tiong Moon, Sing Hing, or even Hiap Tong. And we also have M&E, right? You need companies to do the plumbing and stuff. So we have King One, T International, and we also have the electrical components that run electricity through the entire building or structure. And for that, we have companies like Chuqiang or even Taising Electric. And lastly, we have painting, just to complete the overall picture. Painters like Matex or ISO team are examples of contractors who does painting. So all of this sort of summarizes the entire flow of the construction. This list is not exhaustive. There are way more companies that are not listed here, but I can't due to space constraints, and there are probably other sub-segments as well. But this is the overall picture, just to get a general gist and feel of how the construction sector actually works. So the main contractor, after they subtender it out and he's happy with the project, they'll go back to the property developer and then he'll say, happy with the project and everything. And then after that, we have the finished product, right? So basically, this is construction in a nutshell. And after understanding this, I will share with you guys from 3 different perspectives why the construction sector in Singapore today deserves a second look, right? So I'll tell you guys from the macro perspective, the company perspective, and of course from the valuations perspective. And after these perspectives, I will then go through the top 5 picks from Lim & Tan Securities so that you guys can have an even closer look at which are the companies we are interested in and which are the companies that can potentially stand to gain from the construction. Okay, first off is the macro perspective. This chart is official data from the BCA, which is the Building Construction Authority. So this chart actually shows the contracts that are awarded from a period since 1995 all the way up to today, which gives us an insight as to how much construction is going on in Singapore. So the blue represents the public infrastructure works and the orange represents private works. So we can see that there is sort of a trend, as a boom and bust. Singapore construction sector and property sector are all cyclical stocks. So we can see that in 07, 08, we experienced a boom, and then because of the crash, there's a bust, and then from all the way here, there's a sort of a boom again. 2013, 2014 is where Singapore started works on the Resort World Sentosa. So that contributed to a lot of projects, and then sort of died down. And then there was a famine period during this area. And then from 2017 all the way to 2020, there was a boom and uptick again, and that's where Lim & Tan first actually signaled that, hey, the construction is booming and it's coming back again. But unfortunately, we saw COVID-19 happening, and this led to a lot of construction works being stopped due to COVID-19 and the fear and everything, which led to a lot of companies doing not so well during this COVID. They all shut down and no works could be carried out. But now, as we are entering the opening phase of Singapore, with Prime Minister Lee's speech last week, we know that, or rather just 2 days ago, we know that the economy is starting to open up, and this Tuesday, and from there the BCA has even projected that the works will even come up to about 32 billion moving forward next year. Now this number 29.9 is interesting because even though it seems high, the BCA has actually revised these estimates twice. So that goes to show they are continually more bullish on the outlook moving forward, right? So these are some examples of the construction works that are going on. The top half is gathered from this year's BCA's data, and the bottom half is gathered from last year's data. So I've sort of compiled a little bit about what the project is going on and what is the estimated cost that will be tendered out to these construction players. So notable projects includes like, for example, the LaSalle College extension or the redevelopment of Fuji Xerox Towers. And last year, we know that there are a lot of projects coming out, such as the Greater Southern Waterfront, which lasts for a period of 2024 to 2029. So this provides the Singapore construction sector with a multi-year revenue that is visible because we know that this project is definitely happening, right? And all of these projects are in billions, so we know that there's a lot of money flowing in through the construction process. So the government is also trying to push for industry consolidation and trying to uplift the entire ecosystem. This is interesting because the government understands the entire value chain and how each of these parts are interlinked with each other. And I quote from Minister Desmond Lee, productivity was hampered by the heavy interdependencies among different stakeholders along the value chain. And this pandemic has shown that we are only as strong as the weakest link in the chain. right? So the government understands how the construction industry works and understand that, now is a time to boost this sector. And with this push, there will come incentives, and these incentives includes like pouring a $55 million productivity fund, the push for integration. Specifically, this will help push for more modular construction, which is more efficient in nature. I'll explain a little bit more later. Training-wise, they have sent bosses from construction firms overseas to help with overall modernization of the construction industry. They are also working on a second construction productivity roadmap to bring the sector's productivity to the next level. The details will be released next year, and locally, they will also cut foreign construction professional firms, those that they can hire next year, in order to boost homegrown talent. So last year, or rather before that, firms can employ about 20% foreign talent, but now it's only 18%. And in 2023, we will see that being cut further to 15%. So this is an effort to boost the local construction scene. So remember, I talk on bottlenecks and everything. This is where the money is flowing in, and this is where the money is coming in. So you should know where to invest in. Now, the next slide will also be quite interesting. I'll be talking about property prices. So the property prices continue to remain robust and increase despite the recent cooling measures. So needless to say, this chart here shows URA's data. Next year, we will see that the private housing will increase, and they'll be completed about 17,000, meaning that the construction work is happening right now in order to be completed next year. So if we went to next year to buy into construction, then we might be too late. I mean, next year we buy into property instead. But right now, construction is the place to look at, right? Because they are doing works now and they'll report their profit at the end of this year. So this is also another table from URA. It is the property price forecast from 4Q21. So we see that the price index has actually increased by 5% and rental has increased by 2.6%. And though this take-up rate has declined by 15%, it could probably be due to a knee-jerk reaction due to the cooling measures. But if you track back the take-up rates over the past few quarters, we find that the take-up rates are usually spiky in nature. Now, this is the property price index by the type of property. Maybe it's a little small here, you can't see, so I'll just get it for you. The top line here shows the private residential, whether it's residential in nature. So we know that, it's cyclical, there's up, down, and now it's trending up. And there's a little spike here. It's on an uptrend, and COVID helped to accelerate residential sales as people all over the world seek Singapore as a safe haven to escape from from COVID-19. So the red line here in the middle shows the office. So you can see since COVID, office has been trending down. I think it's quite self-explanatory. A lot of people are working from home right now, so the demand for offices has started to wane down a little bit. And for the last line, it shows the retail line. So retail also, needless to say, is going down because, people are not inclined to go out due to COVID-19. But since the economy is opening up, we are seeing signs of recovery in a small little uptick here, and which also represents another sector to potentially look at. But of course, that is a story for another day, right? So there is in the industry, what's happening now is that there is consolidation of financially weaker construction firms amidst the imminent construction recovery. So this is good for the construction industry, for those who survive, because they are much financially stronger. So you see the headline news, propped up by government support last year, construction sector could see more exits. Things just went south, construction firms under pressure. We have after Great Earth past, BTOs face delays. And even Tan Kiat Hao also mentioned that a lot of construction firms ceased operations in 2021. So before COVID-19, even though there was a small upturn, before that there was really a famine period, and construction firms were already struggling to survive. So I would say that COVID-19 is really a nail in the coffin for those who are financially weak, and the GSS could only provide transitionary support to help the workers and not the firms themselves. Because if the firm themselves have no projects, they won't be able to survive moving forward this year as the governmental support starts to wane down, right? So in fact, this is good for stronger companies, because now given a booming, soon to boom construction scene, more projects available, there will be less companies to share the overall pot. So each company's proportion would be more ceteris paribus. So in terms of the valuation perspective, I will also go through that. So we have compiled by sectors. We can see that we have developers here, we have main cons here, we have cement, and we have steel and cranes and electrical components, yada, yada, right? So what's most interesting you see is that the focus is always on the property because the market cap is the biggest. But as we go down the line from developer to main con to subcon, we see that the market cap gradually gets smaller and smaller. So as a result, maybe because of that, and it's not exciting, unlike tech manufacturing stocks or banks or properties, the construction sector remains unloved, and people don't really like it. So, but if people don't really like it, this also represents an opportunity for investors to generate some alpha. So here we can see that, the PE might look high at first glance, but it's because the industry is still recovering from the aftermath of COVID-19, right? The construction sector is quite unique. We have to buy in when the companies are making losses, so that, when they turn, they'll be making supernormal profits. And then, but by the time more people have already caught on, and then it'll be too late, right? So, but the thing is that right now, the current PE is not really reflective of the industry here. We must look forward to see what is the forward PE that these companies trade at. And you can see that most of it are NA, because currently in Singapore, there are not much analysts covering construction stocks in Singapore, right? But if you see, there are certain bright spots in companies, even now, right? Even you cannot just look at the PE, you can look at price to book. Their price to book is very cheap, right? 0.22 times, 0.36 times, and even some of them trade at very high yields at 7.6%. So the question is, are these should we use price to book? Should we use PE? Should we use EV/EBITDA? Or should we even use yield? Is the yield sustainable? Is the book, right, trading below book? Are they generating profits, right? So we have actually compiled a list of 5 stocks to present, and to show you guys that these companies actually is worth a second look. So of course, this list is not exhaustive, but they just play a part in the entire ecosystem, and shows how this whole value chain, supply chain works, and how interlinked they are. So with that, we have our top 5 picks: Kyungwoon, Chuchiang, Penn United, KSH, and BRC Asia. So without further ado, after going through all the perspective, I will share with you guys more intimate details about the particular stocks. Okay, first and foremost, we have BRC Asia. We start from the start of the value chain, which is the materials provider. BRC Asia is a prefabricated steel provider with about 70% of market share in Singapore after the full acquisition of Lee Metal. Okay, so this is interesting because there's a CCCS in Singapore. They actually passed this whole acquisition, right? And BRC actually supplies steel reinforcement bars, wires, meshes, etc. on a cost plus model basis, right? Market cap is not big, but also not small at 428 million. Excuse me. And the dividend yield is about 7.6%. Okay. So first and foremost, their large market share implies that the bigger construction projects that requires steel have to be somewhat procured from BRC Asia. Steel is the foundation of most, if not all, structures. And if you want, if you want to build big structures or even build a small structure, you will need steel. And having a large market share means that most of the steel in Singapore that's being bought will go through them, right? And this means that there's a lot of business flow going for them, especially in a booming construction environment. And currently they have sorry, excuse me. So currently they have about 1.3 billion worth of order book, and this is interesting because they have 1.3 billion of order book, and this translates to about 260 million worth of revenue that is already fixed and really confirmed over the next 5 years if you divide it equally, right? But of course, most of this order book is front-loaded, right? So that each year, the first 2 years, will see most of the order book being fulfilled. So of course, over the course of the year and next few years, BRC can take in more orders as they fulfill them continuously. Their capacity is 90% now. So now they can pick and choose what projects they want to do, right? If it's not so good, they can just forget about it. But if it's good, they can just, they're now in a position to select, right? So under the Porter's 5 forces, they have a strong, they are a strong player, they have a strong position. So remember that this is on a cost plus basis, so they charge for the work that they do on the steel that the customers already pay for, right? So of course, sometimes they might take positions in the steel to generate some alpha, but from the company's perspective, all the contracts made at a point in time will never be loss-making. If they think steel is going up, they'll buy more steel now and charge customers higher, but of course, depends on the availability, right? And of course, if the steel price is going down, then they will engage in forwards to lock in the price of the steel moving forward, but settle the contract now so that they can also gain that particular margin. So even if price of steel goes up or goes down, it really won't affect them that much, right? Because I know that the key topic in town these days is inflation, the Russian war causing all the oil and all the prices to spike up, right? So BRC is backed by China's largest steel trader, which is eSteel, and with that comes a few benefits. This business is not rocket science. Other players can come in because it's just cut and bend, right? The question is whether or not these players can procure that steel. And being such a big market player and backed by such a big player, BRC buys steel by the shipload, right? So this ensures sustainability of the steel that they can provide for their customers, and also the price. And also, if there are cheap shipments of steel that happens to appear in the market somewhere, BRC will also buy for future use. And also, they will be informed of whether or not there are available steel nearby because of its sheer size. And they can absorb that much because they actually use physical steel, and they're actually not contract steel. So the biggest margins for BRC Asia is actually HDB. And as we can see here, the government's push for faster building and more BTOs post-COVID-19 will greatly benefit the bottom line. So in the previous slide just now, we also saw that, the bulk of the private residential will complete next year, meaning that it is under construction now. So my friends, the time is now for BRC at least, and the construction stock in nature, right? And as with all our stock selections, one of our first criteria is the stability of the balance sheet. We don't want to select stocks that, they are financially unstable and they will go bust, if they're over leveraged. So fortunately for us, BRC's balance sheet is robust and they have strong, consistent cash flows. On first sight, the gearing might look high, but they're all backed by LOCs and backed by physical steel, which they have actually already entered a contract into, right? So this is an ongoing basis and has been going on for quite some time, right? And for dividends wise, they have been raising dividends over the past years. And when this year closes with a higher profit, we think that they might be even able to pay higher, maybe 9 cents, and in tandem with the increased profits. And because of this construction boom, and based on the cash flow and the balance sheet, today's 8 cents dividend at today's price translates to about 7.6% yield, which I think is very sustainable. And I think it's higher than quite a number of firms out there as well. So this chart is interesting. So BRC's 70% market share actually came about because of the acquisition of Lee Metal a few years ago. So which I mentioned was somehow approved by the CCCS, Competition and Consumer Commission of Singapore. We can see by the red bar that after the construction boom in 2014, due to the building of RWS, it started to decline. But it is a similar trend throughout most construction companies. And with the consolidation of Lee Metal, they took about 1 year to absorb Lee Metal into the balance sheet. They came back stronger than before, and unfortunately, COVID hit them and they suffered a decline. But they still managed to make profits, which is quite interesting because, as you mentioned just now, most companies, construction companies, actually fail and go bankrupt in the case of Great Earth, right? So moving forward with the high amount of market share and increased projections, increased construction projects, BRC is likely to do well. I wouldn't say confirm do well, but of course I don't want to give absolutes, but there's a high chance that they will do well. Okay, the next one is Dongwon, which is a crane. Cranes are used to lift heavy structures. It's quite interesting for this company as well. So TWC, or Dongwon Corporation, is a leading one-stop integrated heavy lift specialist that supports the oil and gas, petrochemical infrastructure, and construction. So the market cap is not that big, 115 million, but you can see that the valuations are quite cheap and that we have a target price of 92 cents, which represents quite a huge upside from today, right? So even though they operate in Singapore, it's just a small market cap, they are the 23rd largest crane company globally with about 548 cranes. We don't believe, whip out your phones, search Dongwon, you can see that they are quite a big company. So The first thing I want to highlight, okay, usually I'll go through the macro first, but I think the one that deserves to be highlighted is that the valuations are very cheap, right? And that Dongwon right now is at the trough of the construction cycle and trades at distressed valuations of 0.4 times book. I mean, how can a company who is profit-making and cash flow generative trade at such a huge discount to their price to book? Because if they sell their real assets, they'll definitely get at least 1 times book, right? And what's worse is that, their competitors, for example, there was one stock in Singapore in 2017, they got delisted, rather taken private, right? It's Tat Hong. So Tat Hong was taken private at about 0.75 times book when it was bleeding and at quite a huge number of debt, right? And this actually shows the what the smart money is thinking, right? And what's more important is that after they took it private at 0.75 times book, they actually relisted it in Hong Kong for close to 1 times book, and they're still trading today. So if we look at it, right, this is quite a huge opportunity. There is a gap, right? Next, okay, so in Singapore, there are construction projects and etc. because of this, there are construction works going on. While general construction such as building houses, is bread and butter for most crane companies, right? But for petrochemical projects, is actually the one that will drive the profitability for Dongwon. So, for example, for Jurong Island transformation, the Singapore government is trying to push for this greener living, right? So for developers, what they make is what the difference between how much they sell to the public, like you and me, and what is their cost input, which is the land cost and the construction cost. So, and while the price is determined by location and market, the cost that they pay is actually settled on with their contractor. So they'll try to squeeze their contractors for every penny, right? So that they can make as much margin as possible. Right. For chemical projects, cost might be the back burner for them, because when the main consideration for oil majors when they do petrochemical projects is number 1, timeliness, and number 2, safety. Right. They need the project to run smoothly and be very safe, so that they can get as much oil, refine as much oil as possible, because there is only a time frame when the oil is that expensive, right? You look at today oil prices are so high, right? So you need the project to run on time, and because of that, this might far outweigh the cost that is needed to build these buildings, right? So as such, you're willing to splash down more money so that the whole project is smoother. And the implication is that, as I mentioned, where the money is flowing into, right? So when the money is flowing into here, crane companies will benefit. And for Dongwon, since they have the expertise to do petrochemical projects, they are likely to ride this tailwind. So for Jurong Island transformation, it represents a multi-year income and more revenue transparency for investors, because the duration is pretty long. Singapore is going green. This transformation will definitely benefit construction companies who are geared to do so, right? And this Hengli project is also quite interesting. It's also another petrochemical project in Brunei, and the phase 1 has been completed with Dongwon as the main crane operator. So they were supposed to start phase 2, and that it was delayed by COVID-19, and it's still being delayed, but it will come soon. And we understand that Dongwon has actually done a good job in the phase 1, and thus it is likely that they will secure phase 2 as well. So if they secure phase 2, which is bigger in nature, of course the flow down to the net profit will definitely be much higher, and this will be a huge win for Dongwon. Next is the PPVC, back to Singapore construction for the flat. So PPVC stands for prefabricated, pre-finished volumetric construction. For all those who don't know, it is a construction method where the building modules are built off-site. So last time, construction is built layer by layer and built on the site. But now the government is trying to push for this PPVC, whereby buildings are built room by room in modules instead, which are built off-site and then transported to Singapore and then lifted and then placed onto each level, sort of like Lego bricks. It's the best example I can give you. So this is why today BTOs can build so fast. I mean, not excluding the COVID-19, of course. And this is interesting because this has a few implications, right? Number 1, it is time saving, right? A lot of modules can be completed elsewhere. You don't need to be constrained by the small worksite that you have. Number 2, it saves manpower on site. And it works with COVID-19 because workers no longer have to come together to work in a small space. They can go elsewhere, outside Malaysia, to actually build it and then be transported in, right? And lastly, in relation to Dongwon, the structure is now heavier because now you're building a module, you're fitting everything inside. So this means that you require heavier cranes to lift the module. And since crane companies are normally charged by how powerful the crane is and how long you rent it for, heavier load means more profits. It's a direct relationship. And the government now is pushing for this type of construction design and have poured in some money to boost this sector. And this will definitely help Dongwon and all the other crane players and the construction in general. I mean, that is involved with BTO, like PenU, BRC Asia, etc. So they're all interlinked, right? Okay, so Dongwon also has a strong balance sheet. Their cash flow is amazing. Okay, I'll show you guys later. And majority of its debt now is tied to the HQ property that they have built. And they have an estimated valuation surplus of about 19.5 cents per share. Today, their share price is only 49.5 cents, but their valuation surplus is 19.5 cents. So you can see what's the difference. But of course, you tell me, Dongwon won't sell the building, they'll just let it, they'll use a HQ, etc., which is true. But it still represents an inherent value, right? So they can, if the price gets too high, they can do a sale and lease back, etc. But that is just a potential kicker, that there is significantly undervalued assets in their balance sheet that is currently not being accounted for. And lastly, it is led by a strong management team which has continually reinvested profits into the company to stay relevant and compete successfully with world number 1 and 2 crane operators, Mammoet and Sarans. So if you go and search, Mammoet and Sarans are number 1 in the world. They only do big projects, right? So it's also interesting, right? Because, with all these big projects, they also want big players. So if Mammoet and Sarans win, then Dongwon how? Right? So the thing is that Mammoet and Sarans only provide heavy lifting equipment for this region in Singapore. So when they bring to Singapore, they will also need help to set up their heavy cranes. And with that, they will also start tendering out to smaller crane players, relatively speaking, to companies like Dongwon or Singheng to help them build the big cranes that are required for the project. So even if Dongwon doesn't win the biggest project, there is still food on the table for them to eat, right? Figuratively speaking, because of this interlink chain which I mentioned just now, right? Everything's all interlinked. So the main point I'm trying to say is that if you win, good for you. If you don't win, you also have something to eat that's left on the table, right? So, but of course, Dongwon can hold their own now, as you can see, right? In this Hengyi project, right? They actually bid with Mammoet, I think, and they have actually won them. So they are not say very lousy, so they can compete. And this is because the company, every time they get profit, they'll invest, buy bigger cranes, buy heavier cranes, so that they will stay relevant in the future, which is what we are seeing now. Okay, so you can see here, this is the ship from Business Times, Tat Hong to be delisted after successful completion, right? And recently also there's this Denzai, which acquired a majority stake in Hwa Tiong and close to more than 1 times book. Here you can see that the operating cash flow is so strong. Just now, right? It's about 150 million market cap, right? But you see their cash flows, when they were loss-making, they were also having operating cash flow. And when they start to make more profit, 7.5 million, the operating cash flow is at 54 million, right? And now, just FY21, they made about 10 million equity profit, but their cash flow is so strong. An average of 37.9 million, right? If you average the past 5 years. And with that, the EV/EBITDA is only 3.9 times. So in terms of cash flow basis, Dongwon is quite a solid company, in my opinion. Right? If you take a look at this historical price to book, we find that, yes, sometimes they even go past 4 times book. Now it's at 0.4 times, so 10 times cheaper. But we'll see what happened. So here, 07 crisis, needless to say, they boom and then they bust, they died. Then there's the ONG boom. Remember I said that Dongwon's profits will come and there's petrochemical project, so there's a boom. And now we have the Singapore Jurong Island transformation, right? And then they died. There was a famine period. And then there's a mini boom because of the building of RWS. Also need strong cranes, heavier cranes to lift all the stuff, right? And then sort of died again, famine, right? And then there's a small little boom here. But then because of COVID-19, the construction recovery was halted abruptly, right? So hopefully now with all the macro data I've shown you, with all the company data I've shown you, history hopefully will repeat itself, right? And cause it to boom again. But of course, not a genie, right? But the history has shown us that, when the construction is doing well, all the stars align, cranes will do well, especially, and together with all the other construction companies. Okay, the next company is also a very interesting company, which is Pan United. Pan United is a RMC cement player with 40% market share in Singapore. It is also one of the top 3 largest RMC supplier in Ho Chi Minh. So market cap is about 276 million, right? And Pan is really an interesting company, right? So it is one of the most technologically driven company that I ever come across in the construction field. So they have innovated, and today finally the fruits of their labor has actually flowered in some sense, right? So during COVID-19, construction workers cannot work because they all crowd together to do work, right? But PenU has this concrete product which requires only one single worker to guide the concrete pumping, as opposed to normal concrete which needs 7 workers. So this is quite innovative, which allows them to continue work in some sense. Or for example, when you want to build a new hospital, those radioactive rooms, PenU products includes this thing called PenU Shield, which can stop radiation from passing through the walls. So for a full list of products, you can go to our website, but they are quite interesting. There are some cement that you can form underwater, some cement that can withstand the expansion and contraction of the concrete during a hot day, etc. Right. So next, PenU has also invested into AI, right? So, nowadays everyone talking about AI, big data, all very fluffy, cannot really quantify. But PenU has managed to, I think, quantify some of it, right? So their AI is quite unique. It serves as a software as a service. So what they hope to do is to optimize the business performance and improve the bottom line directly. So it is modular, customizable, and interchangeable, and is built specifically to overcome their own operational pain points. And then they will also offer this service to their competitors. So before COVID-19, they have actually signed a MOU with a South Korean company, I think it's called Eugene Corporation, to explore this further. But of course, COVID happened and this thing is delayed, right? Okay, next one is share buyback. It's also very interesting. Okay, later I'll show you a slide, right? So right now, they have consistently bought back shares from 9 December at an average price of 33 cents, right? Most of them is bought at 35 cents, okay? This suggests that, the management, the smart money, the owner of the company thinks that their own share price is cheap, right? Who are we to argue against them? And lastly, this also might look a bit fluffy and a bit, in the sky sort of thing, to say that, PenU is in the forefront of sustainability. For most companies, I also won't put sustainability as one of the investment merit, but, PenU is probably one of the first few companies that can make going green into a profitable venture. And this is boosted by the Singapore government pushing for a greener Singapore, right? So internally, PenU is studying the use of electric and hydrogen fuel cells to power its 1,000 trucks. They call it our trucks. And they will be able to leverage on this and provide this logistics service to other players who are unable to splash down large capex on their trucks, right? And externally, being the leader for low carbon concrete products, PenU can also secure projects that places an emphasis on sustainability, right? Such as large infrastructure projects like Linde Gas Project or in Jurong Island. Government who want to build those structures will also look for PenU if they want to be more green. So what is this product they have? Is this carbon cure? So apparently they can build concrete, they can help to trap the carbon emission and convert the carbon emission to something useful, right? How this works, I'm not sure of the science, right? But it's very interesting. And given that, Singapore will push for higher carbon tax, right? From $5 per ton to $25 per ton in 2024, this will definitely come into handy, right? So $5 per ton is already is very little. In fact, the world has laughed at Singapore for being a first world country, but their carbon tax is like third world, right? So Singapore also want to increase its carbon tax to $25, and this significantly increase will see companies actively seeking greener stuff so that they don't want to pay so much tax, and this will come forward in 2024, right? So, but now the time to start is now. I mean, don't wait until the carbon tax kick in, right? You need to start doing it now. So, which is why we like PenU quite a bit for their technological prowess. So here we see that, PenU also boom and bust, cyclical stock. And you see that 07 crisis, they boomed, then they died. Then RWS construction, they also boomed because RWS need to build a lot of concrete, and they died again because of the Xinhua port restructuring, which is no longer in their balance sheet, okay? And now they are starting to have a little small boom, right? So hopefully you'll go back to, to the peak levels. Okay, this slide is interesting. Okay, so this I compared PenU share price against the ready-mix concrete price. So ready-mix concrete price, you can find it on the Singapore data, Singapore SingStat, I think. So what I did was to compare the price and the RMC price and find that it actually has a correlation, right? But when I drag the timeline back, a few months back, we find that the price actually lags the raw material price by about 2 years. So if you understand correlation, if there is no like for like basis, the correlation is only 0.4 times, right? 1 times means perfect correlation. RMC price more $1, penny price more $1, right? Same thing. But if I drag it further to 18 months to 24 months, I find that the correlation increases to about 0.9 times. It's very close to 1. I mean, 1 is perfect. It's rare that you find 1, but 0.9, I think it's as good as you get, man. And we see that, when the RMC price move, the penny price will move slightly later, right? And it makes sense because when they buy the RMC price, they will need to spend money, right? So there's more demand. And then when they start to build it, and it takes time for the profit to kick in, right? So this is sort of explanatory, I guess. And now for the share buyback, okay, this is also a very interesting chart. You can see that this split this chart into 2. This is the current timeline. The green one is below. You can see that from November to March 22, their first buyback is at December 2021, right? And gain to date is 28.7%. Okay, there's a sharp spike here because at this point here, 30 odd cents, Lim & Tan initiated a buy, then it goes up by 14%, okay? But I mean, if you're a client, you will have caught it, right? And here, there's no price because it's the future, right? But this 20.7%, remember, so the last time they bought back shares was in 2012. So the first buyback was in May 2012 at 58 cents. And then they bought back, from May to December, more than 6 months, and again 36.3%. And even after they buy finish, the price still continued to move up, right? And for 2012, they bought back a total of 8.5 million shares. For 2021, now they bought back 4.3 million. So seems to suggest that there is more shares to buy, and even if they stop buying, the price will continue to boom. I mean, this is all historical analysis, but it goes to show what the management is thinking, so we can have insight in some sense, right? Okay, next is electricity components, Chuchang. It is one of the leading retailers and distributors of electrical products. You might not know it, but the structure you're sitting in right now today maybe use Chuchang products, right? Because they have about 60% market share. Interesting, right? So Chuchang represents about 60% market share, and the demand for electrical products come from its connections with renovation contractors and also from its 10 retail branches in Singapore. So they distribute a lot of popular products such as Legrand, Hager, Mistral, Schneider, Philips. Some of them I can't even pronounce, right? All those are Chim Angmo names, but Angmo means good lah, right? For especially for electrical components, right? So they are the main distributor, and they also own 2 proprietary in-house brands. So proprietary in-house brands generally have a higher margin now. Okay, so as the construction sector resumes its recovery, we expect Chuchang to actually benefit from the increase in the sales of electrical components. And 2021 has been a good year. And just like I told you, all the property coming up, all the private residential BTO, right? Chuchang being a 60% market share will definitely take part in this, right? So Chuchang also has increased revenue prospects. So, in FY21, they try to have some project order so that, for example, a condo is building a project, they try to be the one as the main supplier. So in 2021, they form out 12% of the overall revenue, and they're trying to grow that, right? So, but currently 88% of demand still consists of non-project sales. And by doing these project sales, even though the margin might be a bit lower, but there is more revenue forecast. So, but this strategic direction also exposed Chuchang to additional market share in the residential, commercial, government, and healthcare segments. So this is what they're trying to go into. And also right now, what they're trying to do is to roll out their higher margin proprietary brands like CCM and CRM. Currently, these proprietary brands account for 50% of the sales, and they plan to increase the contribution to about 70 to 80%. So this means that, as they grow, they want to grow their higher margin products. So last time, the gross margin is only about 24%, but now gross margins is about 29.3%. So the difference is that the price is cheaper but the quality is still there. So most people now are buying BTOs. They are students, and getting younger and younger. So this product actually suits them, right? Okay, so more interestingly, as with most of our companies, we also have deep value staff inside. Okay, so Chuchang actually owns 12 investment properties which are used to generate rental income, and they account for 21% of the total assets, but only generate about less than 1% of the FY20 revenue, right? And so what happened is that they are now trying to sell these non-core assets to focus on a main business, and if they do sell their properties at a fair value, it might be given on special dividends, right? The company has been known to give out dividends. See a 6.2% yield here, right? The sale will provide, depending on the cash flow, but the cash flow is very strong. The sale will provide either increased cash flow or increased dividends, right? And Chuchang now, I think the price is quite cheap. It's trading at about 7.7 times forward, which is a 40% discount to its average valuation since the IPO in July 2015. They also have a strong net cash position. Look for bargain opportunities to expand its retail outlets if they need to increase. And most recent FY dividends of 2 cents is an attractive view, 6.2% based on the share price of 32.5 cents, right? And Chuchang has been providing steady dividends, and more recently, they have declared a formal dividend payout policy of 50%. So their dividends will directly tie with the net profit. And given that we know property is going to boom, construction is going to boom in the next 1 year, 2 years at least, the increased dividend will translate into higher profits and therefore translate into higher dividends for Chuchang shareholders. Right. Once again, this is a chart. Analysts love chart. I love chart. So we can see that copper price tracks directly with the semi-annual revenue. Most of their stuff they sell is copper based lah. So if copper price rise, we also know that Chuchang will rise. And it's quite interesting because Chuchang's inventory turnaround is only 4 months, so they turn around quite quickly. So it's quite reflective in some sense. Okay, the last stock is a main con, KSH Holdings. Is a homegrown contractor come developer. Is very experienced in developing projects. A lot of projects you might not know, but it's actually developed by them. Mount Alvernia Hospital, you can see here, KP, NUS. They have clients from corporates, government, state boards, etc. Right. So right now, the most important thing for KSH Holdings is that they have visible revenue recognition from successful projects in Singapore and China. This is Gaopei Tian. Okay, so Gaopei Tian is in China and they have sold but not recognized yet. So as time goes by, they'll recognize it and they'll have increase in revenue. So the company's share price has been lackluster because they don't know whether they can sell or not. But now really sell already. So only haven't recognized yet. So then this therefore represents a gap in the market to buy now, to capture it when the earnings come in. Right. So recently they have a loss of about 3.9 million, but they turn around about 10 million profit in the first half. So the annual construction revenues remain about 250 million, which provides construction profits about 10 to 20 million. Right. And more importantly, they also have a strong order book of more than 547 million, and this will last through 2024. Right. So it's also visibility in revenue. And lastly, they have a strong track record in handling construction projects. Okay, so their yield is also strong, with also 5.7%, and the valuations are also quite cheap, 10.5 times forward PE and 0.6 times book as a contractor and developer. That has yet to recognize their profit. So I mean, if you tell me, why don't look at UOL, all this bigger one? I mean, smaller cap. There is more upside, more risk, which is the recognition of the profits, right? But at this price to book, the valuations are cheap enough. It's worth considering KSH as a main con. Okay, so I know there will be Q&A session. I will roughly leave 10 minutes for Q&A. But I try to highlight all the concerns into 3 broad categories. I always like things in 3s. Okay, so the first one is interest rate, right? Read in some of the questions, right? Interest rate will affect them or not. Okay, so I'll go through. Okay, so higher rates will definitely affect the razor thin margins of the construction sector, right? Construction sector, very dirty one, right? Margins are razor thin, a little bit of thing, do wrongly, make loss already, right? And but the thing is that the firms that we have selected are cash generative and have strong balance sheet, right? So BRC Asia, okay, BRC Asia is the most scary one, 170%. But as I mentioned just now, most of their debt is tied to letter of credit and backed directly by physical steel. So unless the price of steel crash, which is not possible given the environment we have today, it's not possible that they need to cough up this amount. And besides, they are backed by China's largest steel trader, E-Steel, right? So to give a background, the operational cash flow is about 128.8 million FY21, and their net debt is about 352, so about 3 years to pay back. So it's not that bad, but this is the worst. This is the worst they can get already, right? For Pan United, it's only 1%, right? And this 1% net gearing is only because they included lease liabilities. If you take out lease liabilities, then there'll be net cash. Yongwon is 24.5% gearing, but most of their gearing is tied to their HQ building loan, which is about 73 million, but it's about 63% of the entire loans. But we see that the cash flow per year is about 50 plus million. So this HQ building loan about 73.3 million loan is not consequential, in my opinion. Chuchang, no need to say net cash, right? They have a lot of cash rich, can give out dividends. Okay. And KSH 6%. KSH has always been net cash, but recently they're going to net debt. But their cash flows is quite good. And given that, you know, in the future they're going to absorb, they're going to recognize the revenue and cash flows going to start to come in, then I think they'll be net cash again. And quite rare that property developer net cash one. Okay, quite rare. Most of them take debt, sell, recycle. Oxley is an example, very huge in debt levels. Okay, the next contention is labor. Right now, labor costs so expensive, cannot find people to do work, etc. here and there. Okay, so there currently exists labor shortage due to COVID-19. Okay, for Tiongwon, not so much because they hire their own crane operators. These crane operators are licensed and far more skilled and need to be Singaporean. I think they don't rely heavily on foreign workers. Chuchang, the labor cost is limited. They do not rely on foreign manpower as they don't really build stuff. Right, it's just sell the copper wires, copper stuff and import, export. Right. Other companies is an ongoing problem, I have to agree, but not that big of a problem. Minister Lawrence Wong has personally promised to, you know, fill the foreign worker shortage in a few months, and he said that construction will take priority, right? I mean, of course, if you want to stretch it, if it doesn't happen, then of course we'll come run into trouble, but I think we should believe the PAP and the government, they have guided us, you know, through the COVID-19 period so well, now opening up, right? At least that's what my opinion is. Raw materials, okay? Raw materials, I tried to address it just now. Depends on the nature of business and who bears the cost of the price increase among contracts, I think. Okay, so while raw materials cost increase, usually it's passed on to customers or the person who want to develop project right? So for BRC Asia and Chuchang, as I mentioned just now, gradually increasing steel copper prices is beneficial because they can clear the old stock at higher prices, right? For BRC Asia, they think that the price won't go up, they buy first. They will need it anyway, right? They think the price is going to go down, then they will enter into forward so that, you know, when the time comes, they can buy it at a cheaper price. So it's not, so the only thing that will really affect them is there is a spiky demand. You know, if spiky demand, then of course, when the contract setting date, then they'll fumble a bit, then that will be quite bad for them. But generally, what we see is that there is an increasing price of raw materials, right? For Penyu, don't worry, all material costs pass on to customers. And for Tiongwon, they don't deal with raw material costs because they are crane operator. They have their own cranes. They just rent to people. They don't need any steel, etc. The onus is on the customer themselves, right? For KSH, will be impacted slightly if they build, no choice. But you know, once again, you know, hopefully this will impact them so much because they really have a huge amount of money coming in from their Kopitian. Okay, so with that, I end my presentation. So I will go through some marketing materials. So if you really like what I say and you want to find out more, you can always become our client, visit lintam.com.sg. You can always call us and draw us a mail. I think we have this $150 fair price voucher for new signups. I think quite interesting. Not many brokers in Singapore have NTUC tie-ups. Okay, so and finally we come to Q&A and open the floor for questions. I'll start reading through and see what I can find. I'll just leave it here so you all can take a note. Okay, so I'll just go through the questions. Okay, will the rise in interest rates affect the property market? This will be bad for the construction sector, right? Yes, no doubt the interest rates will definitely affect the property market. But what we are aiming now is the construction that's being built today. I mean, if you want to build project, it should be in the process a few years ago, right? Last year, they really en bloc, like the recent en bloc of a lot of structures. I cannot remember, but the thing is that you already en bloc, you need to build, right? And once you have built, the process is started. So whether or not they can sell to property to retail in the future is their own problem, right? But what's more important is that the construction company is starting to work now. And you know, in Singapore, unlike Malaysia, you go Malaysia, you will see a lot of unfinished buildings and structures. But for Singapore, I think it's an offense to leave the structures unfinished. So you need to see the construction completed, and that's where, you know, construction sector will still be viable today, right? And but of course, if the interest rate really rise too much, then this will be a problem for the sustainability of these stocks. But I would say that construction stocks are very cyclical in nature, right? So they're going to boom, up, down, right? So we need to catch the boom. But before it boom, we really need to buy in, because by the time we boom, you don't want to be the last one sitting on a musical chair, right? So you want to buy in before the boom and then sell before it crashes, right? a bit sad to say, but that is the nature of Singapore stocks. We're all very cyclical in nature, especially property. 10-year cycle, boom, up, down, up, down, up, down. Okay, what are the leading indicators for the construction companies, and what risk do you foresee that will delay the construction sector's upturn again? Okay, the leading indicators, I tried to show you guys a little bit just now. For example, the raw material prices, right? So in the Singapore things that I think you can get the raw material prices of three. I think it's cement, steel, and one more, I can't remember. But an increase in construction materials will definitely will definitely point to the fact that there is increased demand in construction. Or very simple, you go to those ID, you fake a bit, you ask them, now construction how? Booming or not? Are you getting more orders? Then you know already. Or you call them and ask, the property sales, how they're doing. So these are some things that we can do as investors to find out more information in a not so orthodox way, but nonetheless still quite viable. And what risk do you foresee that will delay the construction sector? Okay, the main risk that derailed the entire recovery of the construction sector really is COVID-19. Because of COVID-19, a lot of things have to change. So companies stop work, workers have to go back to their own countries, people all work from home. Construction is really a hands-on project, so you really can work from home, right? So that's why the companies which I've presented sort of shielded slightly. I won't say not completely shielded to a certain aspect. Like for example, PenU, they have this new innovative stuff that requires them to book around the government's rules of from 7 men become 1 man, you can book on the project, right? Or for Tiong Woon, they are crane operators, right? So it's also okay. So one thing I forgot to mention is that Tiong Woon is a crane operator. So for a fixed project, right, you take 2 years to build, you take 10 years to build, you need the same amount of steel, you need the same amount of cement. For Tiong Woon, the crane period, the rental is not fixed. If there is a delay in the project, there's a higher chance that the cranes need to be there for a longer period of time. And with that, Tiong Woon can charge our customers more. Now, of course, we cannot be too overboard, right? If the customers are already dying because they cannot continue construction work and recognize revenue, you also cannot charge more, and that's an opportunity loss. But in that sense, I would say that Tiong Woon is has a special spot in the industry. They are not so affected by work stoppage, etc. Right? And for Chuchiang, they will be affected in some sense. But of course, their importance will only come in at the end when they do all the electrical work, etc. Chuchiang's dividends yield of 6.2% looks attractive. Can it be sustained? Okay. I would say that the yield is sustainable. So a few things I look out for when I look at yield, which is what is the macro outlook, how much you can do, and of course the operational cash flow. So Chuchiang doesn't build, right? So they have a fixed margin, right? I buy from overseas and then I just distribute out. So based on their operational cash flow and based on their revenue and based on their current recent profits that hasn't taken into consideration the construction boom yet, I would say that next year the profits will increase even more. And I wouldn't even say that the dividends can be sustained. I would say that the dividends can be increased because they have a fixed policy of 50%. And the owner has even come out to say that I will fix my policy for 2 years, right? So this means that he has a sort of a certain outlook for the next 2 years, right? And you can see the owner owns the most, so he will stand to benefit more if he pay more. And I would think that it's quite good. At this price can be sustained, but of course, if you buy in today, the price may go up, and if you go up, of course, the yield comes down. So even you don't get so much yield, you get capital appreciation in some sense. But of course, I must caution that construction sector is really a cyclical industry, and that you must get out before it's too late. Don't wait until it's too late, right? And the telltale signs are the number one, the PCA. Every day refresh it, okay, not every day refresh it, okay, but every quarter refresh it to see what news they come out, right? If you see the raw material price coming down, try to find out why it come down slightly. Is the coming down sustainable? And try to get some look and feel with all the contractors that I mentioned just now, right? Call the ID, etc. The counters are small cap. Will liquidity be an issue? Okay, I agree with you. Okay, so liquidity is an issue. Okay, so a lot of people like the bigger players because they are more liquid. Firms can enter, but me and you, we are all retail, and retail players should be able to enter. And the thing about Singapore stocks is that when it is unloved, no one look at it, it is very liquid, right? So no one want to buy, right? A perfect example is if you all follow this counter called Samudera. Samudera last time was 24 cents. Lim and Tan also initiated on it. Okay, so at 24, 25 cents, no one want to buy one, right? Then when the profits come in and the thing spike up to 50 cents, 60 cents, suddenly it becomes very liquid. Everyone to trade, right? Today's at 90 cents. The liquid is so vast and so enormous. So it is a low liquidity can be a telltale sign that that is unloved and that no one wants to buy, and that represents an opportunity to buy in, right? Because I give you an example, right? When the share price is high, everyone want to buy, right? But when it drops, no one want to sell, no one want to take loss, so they hold. So they hold, then people cannot buy in, no liquid. But when it starts to go up again, then it's more liquid, right? So one telltale sign to buy in, when is the right time to buy in, is when there's no liquidity. So if there's liquidity, then you know that the market has already moved, right? Tiongwoon is an interesting company. Do you foresee Tiongwoon increasing their market share with such high capex spending? Okay, I would say that one thing I'm going to mention about Tiongwoon is that right now they are about 50% capacity. 50% capacity because of COVID. In fact, it used to be more. So I wouldn't say that they look to increase their market share. It's more of securing the projects that comes as and when. So for example, the Jurong Island project, or the Linde project, or the Chris project, right? So as long as they win this project, then they'll be okay, right? Bigger projects that they win will definitely be more beneficial to them, all right? Some sense. Okay.
Nicholas, I'm afraid that we're at time, but if you want to take one last question real quick.
Okay. No, I'll probably want to take one last question because there's only 30 seconds left. But thank you all for attending my talk. Hope you guys found it beneficial. If you have any question or queries, please, of course, reach me via this email or call my office or be a client. I think I can provide you with much more than what I presented today. Okay. Thank you very much. And hand it over to you, Edward. Thank you.
Thanks, Nicholas, and thanks for the alpha.
Yeah.
I mean, I'm going to be honest. I took some profits from the CLI recently, and I've been looking for where to redeploy it. And after your presentation, I know exactly what I'm buying on Monday. So thank you for that.